Hey guys, welcome to the Commercial Cash Flow Show. I'm Kenny Wolfe with Wolfe Investments, and my co-host is Ronny Phillip with Kingly Acquisitions. Today we're talking with Mark Allen, a multifamily broker with Greystone Investment Sales Group, about the current state of the multifamily market and an outlook for the rest of 2019. Stay tuned, we'll be right back.
Propelio TV is sponsored by Noble Mortgage and Investments, Batch Kip Tracing, and CreativeCashFlow.com.
Welcome back to the Commercial Cash Flow Show. I'm Ronny Phillip with Kingly Acquisitions, here with Kenny Wolfe with Wolfe Investments, and our guest today is Mark Allen with the Greystone Investment Sales Group. So today we're going to be talking about a variety of topics from the multifamily market overview, Mark's background and how he got started, and then things to do whenever talking to brokers and more of that. So Mark, welcome to the show, man.
Yeah, thanks for having me.
Yeah,
Thanks.
Thanks for coming.
Yeah.
So Mark, give us a little introduction about yourself and then how you got started in multifamily.
Sure. So I went to West Point, the U.S. Military Academy, and from there had to serve in the military. So I was in the Army for some time. And but anyways, my dad was a developer and builder in Orlando, Florida, in the single-family space. So I kind of grew up with that background. His parents were brokers and real estate agents in the residential space. You know, they probably did some small retail or commercial in my town. So with that background, I went to West Point, and at West Point, coming out, they know you're going to have a guaranteed job in the Army. So they give you a $35,000 loan at a 0.5% interest. At least it was in 2009. Yeah, I don't know. Obviously, you know, we're at 0% interest rates then. So really low interest rate. My dad said, hey, I know the market's going to go back up, so you're going to buy real estate. So luckily I had that hand on me. He pushed me into real estate. So he helped me find a foreclosure. I purchased a 2-bed, 2-bath condo for $20,000.
Wow.
And today I'm actually about to put it on the market for $85,000. So, you know, it's Melbourne, Florida. It was 2-bed, 2-bath. I put a little bit of money into it. And I was like, you know, I'm 20, 21 at this point. I'm like, hey, this cash flow thing is kind of cool. So started reading books on little to no money strategies because I was a broke college student. Got out into the Army, was still broke. And so anyways, I came across a couple of different strategies, one being acquiring homes subject to the existing mortgage, sub-2 deals, many have heard of that, and other creative like wrap mortgage strategies. So I was doing some wholesaling as well, just kind of beating the pavement. It was still pretty early on. I was kind of in that Georgetown, Round Rock, Killeen area. I guess I should have prefaced that I was in Fort Hood, Texas, which is down in Killeen. So I was pretty close to Austin, obviously a great market, and halfway between that was Georgetown and Round Rock. So yeah, I was doing a little bit of that, and I had 7 homes and then ended up selling those off, coming here to Dallas after I got out of the Army, and basically was flipping homes with some of that equity that I had built up. And it got to a point where I was like, man, this is, you know, I was working with a software company doing software sales, and then I was flipping homes, and I really had no life. So I was like, I want to become more passive. And here in DFW, we have a couple of local mentorship groups. I can't remember. I got connected with a guy named Chris Rush, who was a Naval Academy grad, and then he connected me with Kenny Wolfe, and that was the start of our relationship. So I connected with some of these guys in the market, like Kenny, who was active and buying deals not only in DFW but other markets, and yeah, I'm like, hey, I want to be more passive. This is what I want to do. So met Todd Franks, who I'm with now, and guy named Paul Yazbek, and who's at a different firm now. But anyways, Paul had a military background, and I was just I didn't know what I was doing, but I connected with some EB5 investors, and I was trying to find a land and maybe put a deal together as well. So that's how I got connected with Paul. I'm like, hey, I see you doing these commercial transactions, so let's get coffee. You know, given he was prior military, it was kind of like a fraternity, so he was willing to meet with me. So anyways, he was like, yeah, you should jump in and be a broker. And I was like, well, doesn't a broker, isn't that a full commission job? And he said, yeah. I'm like, well, I may be open, to it, but because I want to be in multifamily, and he was brokering multifamily for the most part. So anyways, that's how I got kind of connected in the brokerage space. They ended up opening up a position for me, a brokerage position, as they expanded the office, and it all kind of fell into place. But since then, it's really only been a little over 2 years, and I've built some great relationships. Obviously, Kenny and I have done a couple of deals here together.
Right. Yeah.
Hopefully, we'll do some more in the near future. So, kind of crazy that one of the first guys I met in the industry, we're able to make some money and do some deals together, and also some really good deals that are great for his investors as well. But I've kind of being the point of the spear as a broker, which is kind of, we're kind of like deal finders. We're out building relationships with buyers and sellers. In my case, I was kind of new, and I wanted to build relationships with folks or investors who had owned for 10 plus years, because I know if another broker, one of my competitors, sold a local syndicator a deal a couple of years ago, they probably had a good chance to sell that on the back end. So anyways, here today I was connected with a couple of different investors and was able to find some deals here locally in DFW, negotiate some kind of equity position with them, invest my own money into the deal, my commission, and kind of work my way into as a multifamily owner myself. So
was that here in Dallas, or where'd you?
That first deal was in Irving.
Irving, okay.
Yeah, and it was kind of funny. It was a mom and pop owner. She was in her late 80s, and I had even brought flowers to her house to build that relationship. And the investor paid a pretty low cap rate, but we knew quite a bit of upside. It was limited really by the current cash flow or current income that the property was producing. And then since then I passively invested into deals, and that's kind of how I found my way more so on the ownership side, which I think is a good segue into how can you own multifamily deals, and I think it's more prevalent today than it was last cycle or even 5 years ago. There's all these 2, 3, 4, 5 person sponsor teams, and they're partnering together because each have different skill sets. My skill set may be I'm really good at raising equity to buy a multifamily property, or I may be really good at finding a deal, which was in my case, which was the situation. Right. Or you could be really good at analyzing and underwriting deals. So teaming up with someone that may need some help. Maybe they're a more experienced syndicator like Kenny. And maybe, I know this is probably not the case, but maybe his limitation is analyzing and out finding more deals because he's got asset management and all these other things to do. So you can really work your way in to potentially negotiate some kind of equity split to get in and be a multifamily owner.
I mean, there's so many ways to get going in multifamily. There's obviously there's so many roles that a deal sponsor plays. Then as we grow, we'll have by end of April bought $57 million worth of multifamily. So in these past few deals, we brought in some equity guys just to make the to take the stress off me, helping raise that extra little bit of money. So we've done that. I mean, there's other ways to get in, like finding the deals, be the guy who bird dogs a deal if you're new and you can't do the deal yourself as a sole deal sponsor. You can go in and find it, and then bring in a experienced guy who can help round you out with what you need with the lending, the asset management, all the different roles in it. So totally agree.
Yeah,
totally agree with that.
And you've, I guess I don't want to say utilize those strategies, but you've done both of those, right?
Yeah,
Worked with someone that's found you a deal, and then also help raise the money, which you alluded to.
Right. Yeah. So I mean, we're our latest acquisition up in Euclid, Ohio, which is in the Cleveland, Ohio MSA. I was there last week for the day, but one of the guys found it. He was used to buying 20, 30 unit deals. They're around that area. He's from there, but found this 126 unit deal. Found me. We connected. I was on his podcast. And then we kind of gelled from there. And so after that, we came in. We did a co-sponsorship. I mean, so he found it. He does the kind of day-to-day activities. I come from Dallas probably once a month. fly up for the day and make sure everything's going well, and we do more of the asset management side for the investors and all that. So there's different ways to carve it up, so for sure.
Yeah.
There's ways to get involved. Ronnie's done a little bit of that too, right?
Yeah, so I've partnered with Disrupt Equity and Think Multifamily and helped raise capital for their deals on 2 deals. We're just closed on 212 units on Monday, and then another 152 units closing next week. So it's been quite a journey. Over $23 million worth of real estate acquired
Right.
by mid-April. So
good.
it's started out to be a great year. That's why I like doing shows like this, so you can show people what is actually possible with multifamily. And Mark has actually introduced me to a lot of great people, and I think that's one of the keys is building relationships with brokers. So, coming from an owner perspective, how does an owner build a good relationship with a broker? Like, because with all these different programs out these days, right? Everyone wants to go and find a deal. So how do you do that? And what can you do to set yourself apart as a syndicator, with a broker?
Yeah. I mean, I think it's really, and from my perspective, there's some investors that I really click with. I mean, Kenny's a guy that I enjoy hanging out with. But versus, maybe an investor that's in his 60s and I'm 31 and I don't have that much in common. Although, I would say that maybe I'm outgoing, maybe a people person, not like most. But anyways, yeah, I guess building the relationship. There's a lot of different ways you can build relationships. But I mean, Kenny and I have been to Stars games,
Right.
just
Yeah.
things that we enjoy doing, going out, having a beer together, catching up. I know about Kenny's personal life and he knows about mine. And so, I mean, no different than any other way that you would, build a relationship. But I think just there's probably a handful of brokers in each market that do the majority of the deals. And there's probably, depending on the size of the market, there's probably a lot of buyers that vie for their time. And to be taken serious, I think, not only just like, the personal side and maybe, I don't know, I've had people send me gifts like a bottle of wine and some things like that, but also like after you actually, get a deal and you transact with them, how smooth does that transaction go?
Right.
Because if that buyer or that investor wants more deals and it was kind of a headache for the broker, they're probably not going to get many deals. So not only the personal side, but actual transaction side helps build relationship too,
Right.
because the broker will be like, hey, I want to bring this guy or girl another deal.
Right, and it's such a small world in multifamily that you've got to play nice with all parties involved. I mean, there's just not there's a lot of multifamily buyers, but not near as many as like single family, where you might be able to do some things where you might not want to do that, be known for that in the long term. But in multifamily, you've got your track record and your reputation, not only amongst brokers but also sellers and other owners is pretty big. So how you transact is a big deal. You want to make sure that you're fair and and the deal goes as smooth as possible for the broker and the seller as well. If not, then you may just have one deal and you're done. I mean, it's kind of like that. But so a lot of I think some of our viewers are brand new to multifamily, and I get this question a lot. How does a brand new person to multifamily sell themselves to you as a broker to be taken seriously as a potential buyer for these deals? Because the questions I have, well, I don't have a lot of experience, I don't have a lot of unit count. I mean, they're worried about these things. But to you, kind of what do you look like when you first meet someone and they say, I mean, how should someone present themselves
Sure.
to you or some other broker, when they're getting started?
Yeah. And this may just be me. Every broker has a different personality style and the way they schedule, meetings and whatnot. But for me, I think it's important is one is credibility, but two, don't just send me an email and say, hey, this is my criteria, I'm looking for a deal. And maybe if you do send me an email, because I do prefer email over phone, try to set up a meeting and come into the office.
Right.
I have a lot of investors that come into the office for just 30-minute face-to-face, really to get to know each other a little bit, but also to understand their acquisition criteria. But with getting to know the investor, and they're new, have they transacted before? Do they have any references?
Right.
Maybe you have an equity story. You say, hey, I have 2 investors. One of them just sold a gas station or something, and the other one has a technology company that he's selling. So between the 2, I've got $2.5 million committed. Some kind of story like that really helps with credibility.
Right.
I know some of the mentorship groups in town have the investors put together a resume or kind of like a pitch book about them and their company, what they're looking for, their background, their experiences, some of those things. So I think all that helps.
Okay.
Versus just saying, hey, this is what I want.
Right. I mean, you probably so I imagine what you don't want to do is maybe say I've got 20 single-family homes. I want to go to multifamily. I want a B and C asset, pitched roof. I don't know where my money is coming from. All those things. You have to present yourself as a credible buyer, especially to these brokers, and especially in a market like DFW, how competitive it is. You've got to be able to kind of set yourself apart, and those in-person meetings I think are huge. You've got to do it. It's a relationship business, right? So you've got to have those Starbucks or PF Chang's lunches or whatever, right? So you've got to do those things for sure.
Yeah, and then I was also thinking. It may be different in other markets, but this market, there's a lot of off-market transactions. And I would say that's probably the case for a lot of the more primary markets. A lot of folks, I think, would consider, LA, New York, Chicago, primary markets. But now, if you're from Texas, you consider the major Texas metros a primary market. But anyways, off-market deals, I mean, that's just part of this cycle with the price appreciation that we've seen. So there's a lot of investors that are, maybe they've hung on for 5, 7, 10 years, and they're like, holy cow, I just got an offer for $80,000 a unit, or whatever the case may be, and so I think it's time to sell. So that being the case, after you have that face-to-face meeting with a broker, touch base with them on a regular basis. Put in a phone call, see what they have, because they may have something that they're about to bring to market, and maybe you can get a first look. Some investors prefer, even though they'll sign an exclusive listing agreement, they don't want to go through the whole tour process and disrupt the operations. So they prefer, so some even provide incentives to the brokers. If you can, bring me an offer at this level prior to, this date, prior to going to market, I'll give you an incentive commission. That happens. All that stuff happens. So anyways, that being said, I think it's good to just touch base with brokers on a regular basis, just to see what they have in their pipeline.
Right. Yeah. Awesome. Sounds good.
What makes a syndicator good? Like, what are some qualities you look for whenever you're looking to work with someone?
So our neck is on the line on every transaction. So credibility, which obviously that makes it just even more hard for someone that's new to the industry. And that's why I almost want to recommend some of the mentorship groups, because they provide that extra layer of credibility, because you can partner. And if you're not part of the mentorship group, maybe you partner with someone like Kenny, that owns 3,000 plus units. Like, that's a good story. So I know there's going to be less hand holding on my end.
And to be able to close the deal. I mean, that's right. You got to be able to raise the money for these deals. It's not like it's a single family home where you can probably go get a line of credit and do it. But so you got to be able to raise the equity as well.
I think the team is really, really important.
Sure.
Whenever it comes to presenting deals. And going after deals with brokers, because if you have a very strong team that has a track record in that submarket, it just makes things a lot easier. And if they've worked with a broker before, makes it even easier. That's how I broke into Atlanta, because Ben, Ferris, and Mark combined. I think by mid-April will be 2,000 units.
Wow.
So it's just that's the best way. Because 2,000 units in a submarket, that's pretty big. So I think that's really important for people watching, is finding deal sponsors if you're going to partner in those submarkets and partnering with them, and then seeing which brokers they've used already to find those off-market deals.
Yeah.
Right, and also it gives you, if you on the GP side, it gives you credibility with brokers, but also lenders, right? So I know a few folks that I've done kind of co-sponsorships with. We've done one deal, and then they're able to go get a Fannie or Freddie Mac loan, out of the gate. So they can point to the broker, say, hey, I own this deal, X amount of units in this market, or multiple deals, and then and then also with the lender, they can on their second deal. In the second deal they don't need me and can go out and get their own non-recourse financing too. So there's multiple ways why you might want to do that, but especially in a competitive market like today, when to kind of set yourself apart and name drop a little bit to get credibility to get the deal under LOI.
Yeah.
So
there's definitely as brokers, we have a lot of people reaching out to us. So those that we don't meet with or have relationships with, they just go into our database,
right,
to get deals. So there's definitely a short list of folks, and Kenny's been on my short list, and that's paid off. A deal that I know is in. I have a pretty good idea of how he underwrites and what he's looking for. So like when I had this El Paso deal, for example. I knew it was a good fit. We had to do some resetting of the seller's price expectations,
right.
But I didn't bring it to anyone else. It was Kenny, and I said, I know this is a good deal. It's a fit for his model. I just have to get the seller to reset his expectations because he wanted some crazy price at first,
right.
And it all worked out. So.
Yeah, I mean, Mark has a special place in my heart for that. So. Well, guys, we're going to head to a break. Thanks for watching. Start getting those questions teed up there in the comment box. Like it, comment, and we'll be right back.
The Propelio Academy, an all-in-one education resource for training in wholesales, subject to wraps, short sales, flips, rentals, BRRRR, property management, and more. Go to propelio.com/academy to get your scholarship today. Propelio.com. What does Propelio offer? Lead generating websites, access to true MLS comps, off-market lead lists, and deal alerts. Get them all today at Propelio.com.
Welcome back to the Commercial Cash Flow Show. So we're back from the break, and we're going to jump into the multifamily market review and a 2019 outlook. So, Mark, let's jump right into it, man.
All right. Let's see if this.
Is it on?
There you go.
Okay, there it goes.
All right. So, so just bottom line up front, when I kind of just give a summary of this this presentation as a whole, I mean, at the end of the day, the multifamily fundamentals are really strong, and we'll go into this. So, not just from demographics, but supply and demand as well. Everything's kind of shifting with this affordability crisis to rental product. So that's definitely grown in demand. So this first slide here is about just kind of looking at economic growth since 2000. You kind of see the waves and the cycle. Of course, we hit the recession in 2009. So that average growth was negative. It's kind of been up and down. Obviously, this is one of the longest expansion cycles in history, as we're here in I guess now, second quarter of 2019. But economic growth has been really strong over the last, coming out of this recession back in 2009, 10, and 11. And it's really just starting to kind of tail off and flatten out. So at the top, obviously, you can see economic growth is strong, but it's likely to decelerate in the future. This is just looking at millennial job growth. I mean, it's booming. And millennials, obviously millennials are important because, and I'll go into it in the next slide here, you can see the age demographics. As far as population goes, just look at the 26, 27, 28. They're the largest age cohorts. And again, kind of going back, so you see this huge boom for early 30s and folks in their late 20s, which is the biggest renter pool right now. So that's great. It supports not only multifamily rentals, but single family rentals. And we'll go into that a little bit later. So, we're here in Texas, but this just kind of gives you a look at some of the large markets with regard to population growth. And obviously investors want to be in cities or markets where population growth is strong, because that's really your demand piece. At the end of the day, multifamily is about supply and demand, right?
Right.
So how many units are coming online, and how many jobs are being created, how many people are moving to the different submarkets or metros.
And the cool thing about multifamily is they don't make any more 70s and 80s buildings, right? But we've got this growing population, so we, obviously whatever they build is typically an A class, maybe an A minus. But when they build new stuff, because the cost to build that is so high, they've got to get premium rents for those units. And so what we buy mostly is B and C assets. 1964 is the oldest one I own. And the youngest one is 2000. 2018. We did buy an A class before Christmas. But anyway, so we've got a wide range, but they don't make any more of it, of the 70s, 80s, 90s product. Some of that, when the A's eventually go to the, as they age, they'll eventually go to the B class, depending on the location. But as the population grows, there's more and more people that can only afford the B and C, and less, that you still have just a small percentage that can afford the A class stuff. So that's what's nice about buying the B and C.
Yeah, and cap rates are a factor of risk. So cap rates are very compressed in multifamily because they're lower risk. Low cap rates is lower risk. So at the end of the day, people need a place to live, and I think that's why so many investors, not just private investors, but institutional investors, have really shifted to multifamily, because it's outperformed the rest of the commercial real estate market. And like Kenny was talking about, typically when we hit a downturn, some of those tenants that can't afford the $1,500 rents in the Class A properties may go down to an older property that's $1,200 rents, because it's a little more economical. So, like you said, they're not building any more of Class B and C properties. So very safe investment, as people always need a place to live. Right. So again, going back to this slide, we see the top metros in Texas really dominates, with Dallas, San Antonio, Houston, and Austin. But it just kind of shows some of the population growth, which again is the demand factor. Adult home ownership rates are still low. And a lot of that is because of affordability. Prices continue to appreciate in the single-family sector, right. And people can't afford a mortgage that's tied to a $450,000 home. Here in Dallas-Fort Worth, if you're in your late 20s, you probably want to live somewhere close to Dallas City Center, and anything around Dallas is more than likely going to be $400,000 plus, probably a lot higher than that.
Right.
Yeah. And the average home price is around $300,000 right now. To build brand new, it's way over $300,000. And another thing I'd like to add for millennials, why home ownership rates are still low, and y'all can chime in on this. I think it's because of student loans as well. I see a lot of my friends, $50,000 to $100,000 in student loans, and they can't afford to buy a house because of the debt they have. So just wanted to touch on that.
I think that's a big piece, and I also think that with millennials, they tend to change jobs faster. So I know of my niece, for example. I mean, she prefers to stay in A class and rent, because she doesn't know where her job. She's got a really good job, but she could be moved from Dallas to London or wherever. And she wants that freedom to be able to move like that. So I think a lot of those. I think that also is tied into it as well. So
yeah, because
but student debt's a big deal as well. And that's not going away. I mean, you can't.
Yeah, it's not, and that's I think that's one of the key factors whenever we're looking at this, why owning B and C class properties is a safe investment. Because when you're looking at this, like baby boomers are going to be moving into these, nicer A-class buildings. And also with the student debt crisis we have here, I think home ownership is going to continue to go down. Especially, I don't think I'm going to buy a house anytime soon. So it's just, and I'd prefer that because I'd rather rent where I live and then own what I can rent. So Grant Cardone talks about this all the time, and owning deals that cash flow versus tying up your money into a personal residence. And everyone has different opinions on that. All my real estate friends watching are probably gonna get mad at me for saying it, but I don't think home ownership is the future. I think putting your money into multifamily investments and getting cash flow is key. But yeah, young adult home ownership, I just wanted everyone to see this because I really think it's going to continue this way, and I think renting is going to be more of a norm now.
Yeah, this is huge for the multifamily sector.
Right.
And again, partly tied to affordability. So housing affordability is low and still rapidly declining. So for 2019, and again, I am not an expert. I listen to a lot of economists and a lot of companies that provide data. And so I'm kind of compiling this data and putting it together to talk through it. So when we talk about absorption, it's really supply and demand. So they're delivering a certain amount of units, and those units are being absorbed by renters. So whenever there's a lot of units coming online and those units aren't being absorbed, then we have an occupancy issue. So we expect strong absorption in, it says 2018, but it's supposed to be 2019. It's keeping pace near these new supply levels. And you can see on the right, I don't think this has a pointer, but 2018, you can see the supply levels, the permits, the starts, and the completions are about in line the last few years. So I think DFW in general delivered, somewhere around 23,000 units last year, but they're all being absorbed, except in some areas like Uptown, where there's been a lot of units come online, Knox, right. Henderson, and maybe Frisco. But anything in more suburban like Denton, there's just a ton of demand right now. So again, construction remains elevated with the permits flat and starts up just slightly. And then completions expect to remain near similar levels. So this kind of gives you the supply outlook. Again, just kind of expect strong demand, keeping pace with all this new supply because DFW created, again, we're in DFW, it's the market I know best, created 118,000 jobs last year. And we expect these fundamentals to continue through 2019. So multifamily is still the investment of choice, and a lot because really driven off these supply and demand fundamentals, which kept vacancy rates below the long run average and the rent growth above the long run average. We have seen vacancy rates, that growth slow a little bit, but like Kenny was talking about, the B and C product is jam packed. It's full product. There's a ton of demand for that affordable product because you bring a new Class A building online, those rents are going to be $1.45, $1.50 plus a square foot versus, maybe a Class B apartment at $1.20 a square foot.
Right.
So a lot more demand for that affordable housing, affordable rents. So again, I think everyone that I've spoken to, including the economist that I'll listen to tonight, he'll probably talk about this, that everything is not growing like it was the past couple of years, so that growth is slowing, but it's leveling out, and the fundamentals still support the future.
And and I watch this daily, is the 10-year Treasury, and so that's been really interesting to watch. It dipped down to like 2.3 something a few days ago. It's back up a little bit, but the 10-year Treasury has actually gone down from 3% down to 2.45 or something around there, and that's what drives a lot of our loans for multifamily. Yeah. So that's really interesting to watch. So I just heard a guy today, he locked an interest rate of 3.85%. I mean, that's for 10 years. I mean, that is for a non-recourse loan on a multifamily. I mean, that's amazing.
Yeah.
But I mean, that 10-year Treasury is something to watch because that's how they base our loans off on these multifamily deals, and they don't base the same when you get a loan for a single family, they don't base it off the 10-year Treasury. It's based off some other metric, not so much the 10-year Treasury. So we're in a little bit different world.
That's right.
When it comes to lending on the multifamily space.
Yeah.
Which is nice, right?
Yeah, and Q4 of last year, kind of when the treasuries were ticking up, there was a couple of rate increases. It really did slow down in Q4 of last year. Of course, we were headed into the holidays, which always slows in my world on the brokerage front. But it really did slow down because there was a lot of uncertainty.
Right.
Where are rates going to go in 2019? So I think the amount of tours and the amount of offers, typically, maybe even earlier in the year, we were seeing 20 plus tours on a property and 10 plus offers, and going into Q4 that really slowed. And talking with some of my broker buddies, my competition, they said the same. But now that we've seen the 10-year Treasury, like Kenny was talking about, tick back down, we've really seen investor demand pick back up this year. So, we expect that to continue through the rest of the year because, the Fed said that, they're dovish on rate increases, so we don't really expect this year really any big rate increases. So.
Right, yeah, no, and that's good. That's good for real estate. It's all based off what you can borrow and what the interest rate is. So, it's a big piece to it for sure. Anyway, so what else we got to talk about today? Talked about the economy, talked about kind of the DFW market. Maybe talk about some other markets that you know of, since we're based here in DFW, but I know you look in a lot of different markets.
No, not as much as in the past, but talking about El Paso just recently, I feel like there's been a lot more investor demand down there too, and I've seen more properties transacting than I have in the past. I mean, there's one owner down there that owns probably 75% of the market, but or maybe I shouldn't say 75%, but he owns the majority of multifamily properties down there.
Right.
And but anyways, I know he's sold off a couple, and so that being said, I think you could probably speak more to it than I can, but it seems like there's, from the investor demand perspective, there's a lot more demand. But why is that?
Right. So like a city like El Paso, it's interesting. So it's the 19th biggest city in the U.S. It's got about 1 million people that live there. But you're right. There's only a few families that own the majority of those multifamily units in that town of 1 million people. So that's kind of kept out a lot of the buyers so far because there's not really a lot of third-party management out there. So unless you're an owner-operator, it makes it tough to buy in El Paso. Yeah. I'm fortunate because I bought into Allied Property Management about a year ago, and so I let them know, hey, we're going to El Paso, and so that helped me get into El Paso when you can break into a market like that. Not everybody can do that, so I think so far we've seen prices stay kind of within reason. But I think that pretty soon, I think El Paso is going to break open because of that. Eventually, once the third-party folks get in there, I mean, El Paso is closer to LA than it is to Dallas. Yeah. So we're going to see a lot of Californians come in. You'll see folks from Dallas come in, like us. It's an hour-and-a-half flight. So it's pretty easy to get to. All the demographics, metrics sounds good. Everything looks good on that front. And it's a town in Texas. People like to invest in Texas. So. Sure. So that's a good market. I mean, we've looked at deals in Oklahoma City before together, Tulsa, as well. So I mean, to me, I get a lot of newbies that ask me, where should I look? And I always tell them, well, first look in your hometown, if that's DFW. Look in DFW, but pick 2 or 3 other markets you're willing to go to get better deal flow. There's a lot of deal flow here, but some of it might not be great deal flow. Quality is what you're looking for. So maybe branch out a little bit into some other markets that you're willing to fly to or drive to get into like that. So anyways, that's kind of my suggestion on that.
What are the different factors y'all look for whenever y'all are entering into a new submarket?
Into a new market. I mean, we talked a little bit about the fundamentals. I think the fundamentals is where you want to start with job growth, population growth. Right. How many units, do you plan to bring online this year, how many are planned for the following year.
Median income's a big deal. I mean, how much rent can they afford? I mean, is it 45,000 a year? Is it 26? Run away if it's 26. But if it's 45 or or higher, then it might be a good place to invest. So median income's a big deal. That's what we look at first when we're showing a property, and not like in the whole city. You want to look within like maybe half a mile, maybe a quarter mile. Sometimes depends on the city, because some of these cities, even DFW, a mile away could be a world away. From on the median income, job growth, unemployment, things like that. Landlord friendly, that's a big deal. We look
That's
for.
huge.
If you can't get them out, then when they don't pay, then it's tough to make your mortgage payment. So that's pretty simple stuff. But
I think job diversity is key as well, because you don't want to go into like an oil town and then when everything crashes.
Yeah.
Well, what do you think about Killeen? Because that's kind of a one driver is military down there, right? So
people have different opinions, or investors have different opinions. I live there, and I think the common perception is that when a military post deploys troops, you're going to get big occupancy swings.
Right.
But at Fort Hood in Killeen, there's 40,000 troops on the base, and they deploy 4,000 at a time. And when they deploy a brigade combat team out, a brigade combat team comes in. Gotcha. So depending on the asset, the property, and what the military concentration is, I think that's, if it's a lower military concentration, of course, Fannie and Freddie will only lend on the property if it's under a 40% military concentration.
Right.
If it's over than that, there's too much risk for them. So if you find a property that's in that 10 to maybe 30% military concentration mark, I think you're hedging against that risk. Right. But at the end of the day, Fort Hood is not going anywhere. That's my perspective.
Sure.
It's always going to be there.
Right.
Because it's the largest military post, it's the largest Army post in the country. So with that, because they're not going anywhere, you have some level of stability. Right. But it's also, just off the I-35 corridor, and we're seeing a ton of growth. Not only while I was there, I left in 2014 with new Walmarts and new retail and all this new growth. I'm not really as tied into some of the new jobs coming in, but there was a lot of development and a lot of growth. Roads being connected to I-35 to get to Austin faster. So,
do you think that's part of it? Is that people are getting priced out of Austin and maybe moving to Killeen and commuting? I mean, is that what you think? That's too far?
It's an hour drive. It's about 70 miles.
Well, so we owned a asset in Colorado Springs, and we started to see people priced out of Denver, and they were living in northern Colorado Springs, which is about 35, maybe 45 minutes to the southern part of Denver, and they started to commute from there. I mean, that just because they were getting priced out of those markets. So that might be something to look at too, is cities that are close to markets that have really appreciated, like Denver or Austin, or even Dallas, Fort Worth, and see, people willing to drive the extra 30, 40 minutes to work and save money on their rent and all that kind of stuff. So that might be a good way to do it. So guys, we're about to go for a break here, but we need more comments and questions. So put them down below. There in the comments and question area. So we'll be right back. Thanks.
The Propelio Academy, an all-in-one education resource for training in wholesales, subject to wraps, short sales, flips, rentals, BRRRR, property management, and more. Go to propelio.com/academy to get your scholarship today. Propelio.com. What does Propelio offer? Lead generating websites, access to true MLS comps, off-market lead lists, and deal alerts. Get them all today at propelio.com.
Hey guys, welcome back to the Commercial Cash Flow Show. I'm Kenny Wolfe, Wolfe Investments. We got Ronny Phillip over there with Kingley Acquisitions. And today in our hot seat, we got Mark Allen with Greystone. Welcome back. So we've got one of the questions from Ed is, can you explain absorptions?
Absorptions. So again, dealing with supply and demand. When a developer builds multifamily property, they're bringing on new units in that sub-market. So how many of those units are being absorbed? If they bring 100 units online, are all those units being absorbed? So there's net zero absorption. versus negative absorption would be probably a dip in occupancy because they're not absorbing all those units. There's more units on online, and those renters aren't renting those units, so occupancy is going to drop. So you want those units to be absorbed in a market. If not, you're going to see rents go south, and you're going to see occupancy go south. So, anything to add?
I've seen a lot of incentives on A-class here in DFW. 1 month, 2 months, even 3 months free. So why is that? For the audience to know, why are they doing all these incentives and stuff? And do you think that cycle is going to continue?
I think over the long haul, DFW will eventually absorb all those. Also, too, it's very specific. If you're in an overbuilt area like uptown, or even like at 121 and the tollway, to me over there in Plano and Frisco area, it's maybe a little bit overbuilt. There's a crane every day, it seems like, popping up over there building stuff. But so I mean, that's part of it, is that if they can't absorb it, they got to throw some concessions at folks to get them moved in, and then their hope is that they renew. They keep some of those renewals and can burn off some of those concessions as they go forward, because I mean these developers have an interest only period most of the time on their on these loans, and so once they go to have to pay principal, their mortgage goes up, and so they're going to need to, so those concessions basically have to stop for them to be able to pay their mortgage, right? So that's part of it too, is when you are next to an A-class and they can do these concessions, you got to kind of stomach that for a little bit, but eventually they won't be able to give those concessions away because they've got to make a much bigger mortgage payment on there. So anyway, we wanted to talk about rent control, right, in Oregon. That's kind of
yeah.
a hot
So
topic,
I
we'll talk
wanted
about that.
to dive into that. What is y'all's opinions on this whole statewide rent control for Oregon? Because this is like a hot topic. I don't think rent control is good. I think it could definitely harm a lot of the landlords, and it'll harm people from continuing to invest into rent control states. So
I know I wouldn't. I mean, you go into a market where if your rent is fixed, how can you pay a higher price for that real estate? And then also, if your rent's fixed, are you going to put money back into your property and make $0 on your investment? To me, it's a bad idea. And also, I mean, you see at states like New York City, you hear about guys that's rent control, right? And they shut off the, maybe illegally or illegal, they shut off the heat in the dead of December because they need those folks to move out to get the rents higher to a new rate, right? So I mean, you hear about those things too. So I mean, I think there might be some unintended consequences if you do things like that, in my opinion. So.
Yeah, I know in Los Angeles, that was a hot topic last year. And what was it, Proposition 18 or one? Yeah. But there were some investors that I work with that were bringing capital from, selling properties in Los Angeles and bringing that capital here into DFW, and they had properties out on the market, and even in escrow, and we're very concerned because if Proposition, whatever it is, that rent control was put in place. That changes the value of the properties.
Sure. Yeah.
Because everything right now is so pro forma driven. So they were concerned that there were going to be significant price reductions, and they wouldn't have the equity. They were already tying up deals. They were buying deals here in Dallas, and really in Dallas, putting deals under contract with the expectation that equity was going to come out of the deal. So,
right.
They were sweating bullets.
Yeah, and I mean, and that's a real world example of equity not wanting to reinvest inside those rent controlled or potentially rent controlled areas. So you'll see probably within a couple of years, people not wanting to do new paint or new interiors to those units because they can't get the return on their investment. So I think you'll see that go down as well. So, but Oregon's not a great landlord-friendly state anyways, besides rent control. So, that's a market that we tend to not even look at in Portland or places like that, just because it's hard to evict them anyways. If there's no payment for rent, it's tough to get them out. A lot of coastal areas are like that. So you got to be mindful of that when you go into a new market.
Do you see investors from these rent control states, besides California, what are some other states you've seen people bringing capital to Texas or landlord-friendly states?
New York, New Jersey, Florida, California.
Philadelphia, I know, Pennsylvania. Sorry, Pennsylvania is one. I've heard folks. Some Illinois as well, Chicago area. I know some folks are that live there but are looking outside of Chicago because it doesn't make sense to buy there because of some of it's to do with the landlord, the lack of landlord-friendly judges and the laws there. So
Yeah, I mean other countries too. We sell a lot of properties to Canadian investors, Japanese investors, investors from Mexico. Right now the Japanese are borrowing at a 1.1% interest rate. So when you talk about the cost of capital there, I mean that's why they can pay a 3 cap or a 4 cap. I think there's a lot of money flooding into Texas. And it's funny, someone mentioned, in the past, Japanese investors, I think they've always been in this market, but even more so now it's really opened up because there's a direct flight from DFW to Tokyo.
Okay.
They don't want to hop on multiple flights. They want to be in and out. Right. So I thought that was interesting.
I think it helps to have Toyota here too.
Yeah.
Now that they moved from California to Texas, so I think that helps with the
Sure.
Japanese buyers as well. On there, it's kind of a proven market, at least in their eyes, that Toyota is here now. So
yeah,
I think that helps.
What about you do a lot of asset management. I know you have an asset manager,
Right.
But you're all about creating value. So what kind of things are you doing, both of you guys, just on the operational front? Any kind of creative things, as we kind of get late in the cycle on some of your new acquisitions?
Right. I mean, we're always looking to improve. One of our assets in Columbus, our neighbor just came, is one of our neighbors up there. They're kind of it's an off-market deal, right? So there's a few of us looking at it, but on that deal, since I'm the neighbor, I know what my rents can be on our upgrade units. Typically in that submarket, and we change them for market to market. Based on what tenants can afford. In that market, it's a little bit higher end. So we do a stainless steel appliance package. We do the faux wood flooring. We do a kitchen backsplash, some fixtures in the bathroom. Some small touches we do that probably a lot of folks don't do in that market is, on renewal, we'll give them, hey, if you renew for X amount at the new or higher rent, we'll throw in a new outlet which has a USB plug into it. It costs us maybe $7-10 to do. Our guy can do it in-house. Not a big deal, but it's a big deal for the resident. So we can do things like that. And it's kind of specific to those buildings. So there's a property bought in Euclid, Ohio, just about a month ago, and so it's in a transitioning neighborhood. Amazon just built 3 big facilities there in Euclid. They tore down the old mall. So it's 1,000 jobs coming right there.
Wow.
But the people that live there now, it's a little bit rougher, and so we're doing kind of a half and half. So half the property, half the units are going to be upgraded with our typical backsplash and stainless steel. The other half will keep classic, is what we call it. So those are mostly just touched up. The guy already put ceramic tile on all of the units, so that makes it easy for us. Change out the carpet, things like that. So we kind of do it just changes on the asset. Per kind of where you are in the world, you have to do that.
What about going into a new market in Euclid, Ohio? I don't know if you were already there, or in El Paso. And when you take over, like some of the service contracts, and I know Allied Management, you bought into Allied Management, but still you're coming into a new market.
Right.
So how do you just kind of figure out who are the players, who do I need to speak with regard to my like trash contract, or something as simple as that?
Right. So we when we go to a new market, I always tell folks, our first deal in that market, the first acquisition we have there, it's a little choppy at first, the first 6 months, because we're trying to find the right manager, the local manager. Once you find that person, it makes it a lot much smoother. So because they know the trash people to call, they know all the discounts, they know the maintenance guys to bring on. So if you can find that local talent that's good, solid, that always helps smooth that out when you go to a new market. But it's finding that first person. I think in El Paso we're on our 3rd on-site manager, and we haven't owned it a year yet. But so we have to keep, we've got to find that right person. And now I think we found her. She's awesome. She's leasing like crazy now. So we're seeing much improvement there. But she knows, like, for example, we're looking to do a mural on that property. And I haven't been able to find a muralist in El Paso, but it's because I'm in Dallas. So she knows somebody. So she's going to, make that introduction. So it's things like that where you can get better local services. She knows the right people to call for cheaper products too there in El Paso. Most of them are probably coming from Juarez across the border, but that's fine. We'll take that product. So that's how we do learn the new markets. Is you got to hire a good, solid local talent.
Yeah.
I think that's really important, even in Atlanta. Like on our properties, we want to make sure we can create a resident experience. So we're thinking of different ways to, keep the residents together with like monthly, some sort of monthly event, right?
Sure.
I don't know, like what have you done lately?
We've done everything from, hand out breakfast burritos on the way to work. We've done that. We've done kind of movie nights. We rent a projector and a blow up screen and have movie nights if it's more of a family oriented property, thing like that. Our new A class in Greenville, we're about to start doing like a wine tasting or you can team up with a local brewery to have a beer tasting there as well. But you got to make it specific to that property. If it's you got to know your demographics. If it's families, then more family oriented stuff. If it's a newer product and maybe less families, wine tastings and things like that might be a way to kind of create that sense of community as well. So you just got to know it, and then change it up too. For Valentine's Day, Valentine's stuff. It's not rocket science, but you want to do something like that to build that community, because a lot of folks that do what we do don't do that kind of stuff. They don't invest that money, and it's really usually not a lot of money to do it, but it's a big impact on your residents. They want to renew, they want to tell their friends about living there, so it kind of creates a demand, kind of a bigger demand for your property than you would otherwise.
You have to, whenever you're as a owner, you have to see what does your property set apart from the other ones. I think experience is really important, especially with different events and different things like that. And I think if you can create an experience for someone, that can change everything for them.
Sure.
So,
yeah.
Any final thoughts?
Any final thoughts, Mark?
Final thoughts.
So we learned that you can be bribed. You should bribe a broker with wine and then or use flowers to get in. We're joking, but that's
I think that just goes back to relationships, right? At the end of the day, no matter what niche you're in real estate, it's all about relationships.
Right.
So we talked a lot about relationships with not just building relationships with brokers, but maybe teaming up with someone to be able to buy multifamily, to scale up and go bigger.
Right. Cool.
What else?
Awesome. So how can our audience reach you?
Sure. You can reach me via email at mark.allen@greyco.com, spelled GREYCO.com. I have a podcast, if you want to check that out. It's on SoundCloud and iTunes. It's Multifamily 5. It's 5 questions, interviewing industry experts just to get a sense of how they're achieving success in today's market, as well as vendors. So some pretty interesting interviews recently there. Of course, I'm on Facebook or LinkedIn, so you can reach out to me on both of those platforms.
Okay.
And Kenny, how can people reach you?
Yeah, guys. So Kenny Wolfe, Wolfe Investments. We're on YouTube, LinkedIn, Facebook, all the social media stuff. So find us there, and then our website is wolfe-investments.com. That'll get you there.
Awesome, and the best way to reach me, Ronny Phillip with Kingly Acquisitions. So you can reach me by email, ronny@kingleyacquisitions.com. You can also find me on Facebook, LinkedIn, YouTube, Snapchat, all at Ronny Phillip. And if you are watching this video, make sure you give us a thumbs up. If you found this video valuable, please share it with your friends and your family. And also leave questions and comments below, because we'll be answering them even after this live stream. So thanks so much for tuning into this episode of the Commercial Cash Flow Show, powered by Propelio TV. If y'all haven't checked out Propelio.com, one of the best real estate investment softwares on the market. So make sure y'all check that out. Be sure to like the Facebook page for the Commercial Cash Flow Show, as well as Propelio's Facebook page. And wherever you're watching, please be sure to subscribe. And thanks so much for tuning into this episode of the Commercial Cash Flow Show, and we hope you have a great day. Take care.
Thanks, guys.
Propelio TV is sponsored by Noble Mortgage and Investments, Batchkip Tracing, and CreativeCashflow.com.
Hey everybody, I'm Ryan with Propelio. If you like what you saw, please subscribe. Turn on those notifications and stick around for more. We have tons of content like this all over our channel. So if you want to learn more about real estate investing, stick around, watch Propelio TV, and we'll see you later.